Welcome back to Turning Hard Times into Good Times. I am your host, Jay Taylor, and I'm really pleased to have David Jensen with me once again this week, as he is with me almost every week to help put in perspective what's going on in the precious metals markets. So welcome again, David. Good to have you with me.
Good morning, Jay.
I want to ask you to give us an update on what's going on in the gold markets. Starting with that, you see your notes to me says that the GOFO for gold it's acting the way you would expect it to, more or less. I guess it's a positive GOFO rate now at 0.84%. Is that right?
That's right. So it's indicating that borrowing gold is less costly than borrowing U.S. dollars, which is the historic norm.
Mm-hmm. And the Shanghai Gold Exchange, Shanghai Metal Exchange Physical Metals Premia, you come up again with your numbers, which you've been sharing with us on a regular basis. I see there's a slight premia for gold of 0.2%, but then silver is pretty spectacular at 9.3%. But palladium is the big one at 16.6%, and platinum at 7.1%. So that means that somebody's paying a lot more, especially for those industrial metals, in the Shanghai exchange than they are in the United States in the paper markets.
Yes, that's right. And I think of note is the continued increase of the premia. Silver is 9.3% this week versus London, and it was 8.1% last week. Palladium is 16.6% versus 16.4% last week, and now a 7.1% premium in platinum versus 6.3%. So all of them are going up. Now, each of these prices, they do include a VAT tax. There's not a VAT tax in London on wholesale purchasing of metal. There is only for retail, I guess, for the Muppets. They would have a silver tax and a platinum and palladium tax of 17% applied to them. So there is a strong price differential for industrial purchasers of these metals in Shanghai versus London. Now, they're not over 17%, but still there's a very strong incentive to move these metals, silver, platinum, and palladium, into the country for, let's call it off-exchange purchases to capitalize on the price differential. So if you have a 16% price differential there, you can buy it for 16% less in London. You could move it in and sell it at some differential from through unofficial channels in there. And one way that we can see this unofficial movement of metal is that in 2013, only about 40% of China's total 1.8 million ounces of palladium that was consumed actually was registered as an imported metal. So we can see that there's a big gap there between their consumption and their official records of imports. So that is of note. And the other thing is too, the Shanghai Futures Exchange, you and I were talking about that collapse now to 95 tons of their total inventory. From 1,180 tons in February of 2013, and there's a further indication of shortage. And keeping in mind that China produces almost 300 million ounces of silver per year, there are almost 30% of global silver production. So we've got 9,000 tons of production in China, and yet their inventories of silver are spiraling down and continue.
Yeah, it's down about over 90% from February 2013.
Yeah.
It's almost next to nothing. I mean, 95 tons compared to 1,180 tons.
Yeah.
That's just how much further can this go? I mean, it's...
Well, it's one of the few numbers that you can't hedonically adjust, so it stops at zero.
Yeah.
So it stops at zero.
Right. So the metals are being drawn down. The physical metals are in short supply, seemingly, and you would think that somebody would look to make a profit also using this, taking advantage of this VAT tax if they can off-exchange or smuggle it through somehow. I mean, human beings have been known to do this in Asia as well as other parts of the world, so you would think that's probably going on to some extent. But what I find really striking, David, is the enormous amount of paper money paper, that is paper contracts that are traded on the LBMA and in the COMEX compared to the actual Shanghai contracts. And talk to us a little bit about some of those numbers.
Yeah, maybe just tying this next point into the previous point, Jay, on a quick note here is that what the pull of the physical metal does is it presents a threat to that paper tower of metal positions which exists in London. And when they have 100-to-1 leverage, I remember that leverage works in both directions.
Mm-hmm.
And this is going to suck physical metal out of London and out of the other exchanges into China through unofficial channels. But it's going to put pressure on London now because of the enormous open positions that we can calculate are there from a few reports that the LBMA gives out, and then they're very opaque monthly numbers that they give out, which are more or less teasers or hints about what's going on. But we have enough information that we can see what's going on there. Jensen put out a profile of the China versus U.S. market, and he said that he wouldn't comment on the London market because we don't have the information, but we have enough from the LBMA's local London liquidity survey of 2011 that we can work backwards through the numbers that they release. And just some high points of that liquidity survey from 2011 was that 90% of the daily LBMA gold trading is in the spot market, and only 5% in forward instruments.
Wow.
And then 5% in other instruments, which I would assume would be options. So, looking at the Shanghai Gold Exchange from Koos's numbers, and remember, this is a real gold exchange where to sell a contract, to write a contract, you've got to deposit a bar first. They're trading about 25 tons a day, or about 750,000 ounces in round numbers per day. And this compares to the using that liquidity survey from the LBMA as well as the monthly numbers that most recently they've been indicating that they've been trading about 179 million ounces of gross volume trading per day. So, between London and Shanghai there, you've got almost, 240, let's call it 238 times the volume in London of the Shanghai Gold Exchange, where they're trading real gold bars. So we can see that there's something, there's a real contrast between those two markets, and that they can't be trading real metal in London, which we know that they aren't. So it's basically just a paper swirl, and we're seeing the same thing in the silver markets as well, that they're trading about 25 million ounces per day of silver on the Shanghai Gold Exchange, and they're trading about 1.6 billion ounces per day of silver, which is greater than the annual production of silver every day on the LBMA. So again, both gold and silver in London, which is a physical market, are basically being driven by paper trading, unallocated contracts. And ultimately, this leads to mispricing of the metals through two things. One is that people who need to sit in the metal to hedge themselves sit in basically unbacked positions, and you can create the metal to quote unquote protect these individuals from whatever they're hedging, just with paper which is not backed up by anything. And then the other thing is that it allows the instantaneous creation of trading instruments to drive down the price. And we've seen that, like in 2013, in June, there was 280 million ounces a day of gold versus 180 million ounces a day of gold being traded. So there's a real strong effort to trade down the price of gold in 2013 on the LBMA. So, but there's real contrast between those two markets. But overall, we just cannot look at the world's gold and silver trading markets, whether it's Shanghai or New York or anywhere else, Singapore, which is opening a physical exchange, without looking at London, because that is the vast majority of gold and silver trading. And my contention is, or my belief is, that we, with this strong pull of physical metal now into China, with these premia versus the global prices, that we're going to see potential upset in London. I would think with palladium and silver first, because those are the metals which are used up and which there is very, very tight supply.
Yeah, the platinum and palladium for sure are just virtually 100% industrial metals. I suppose a few people keep them as a store of value as they would for gold and silver. Silver less an industrial metal, more of a monetary metal, but a lot less than gold. So it's very interesting that they would be paying those premia, and that there would be that opportunity for arbitrage, if you will, unofficially. For people, I would certainly think that would be happening. If I have some platinum or palladium, I would want to, and I'm in the West, I'd want to get more for it than I'm offered if I could get it from through some other source. And so you'd think that would have to be going on. So what do you conclude from all this? What's the bottom line for investors in general?
Well, physical metal is where it's at. We can see that all of these markets, except for the Shanghai Gold Exchange, are levered is a polite word, but that they really have positions which are unbacked or largely unbacked. And the migration into physical is going to upset this paper creation. And I think that's the best we can say is that there's going to be shortage. There's potentially going to be a London market event at some point, and I would expect it to be palladium first or silver. We will see with time which it is, but that this draw, this suction of metal into China is going to impact the global markets.
And I'm trying to understand, though, how one could lead to the other, because I believe it's your contention that you think, as you just stated, that it would start with platinum and palladium, probably move to silver, and then ultimately to gold, which has the deepest market. I suppose the gold markets are the and so how would one lead to the other? Would it be a psychological thing, or what would be the connection between platinum and palladium and then silver and then gold?
Well, for when you've got 100-to-1 leverage of paper to physical, you've only got 1% of the metal there notionally backing the contract. Mm-hmm. So if somebody is sitting on a contract and they call for delivery, you only need 1% of the outstanding contracts to take delivery, and all of your physical is gone.
Right.
So that's the reverse impact of leverage. It's a great way to create metal that's not there, but if you ever have the demand for the actual material itself, you quickly get into a market a disruption.
Right. I could certainly see that happening in platinum and palladium very quickly, I think, and silver too, probably, because they're all industrial metals. But with gold, it seems to me you'd really have to have a psychological change. You'd have to have people, because most of the guys, as you point out, it's just a huge paper trade, and most of these guys are using it like a gambling casino. I believe I'm betting gold's going up, and someone else is betting it's going down, and the contracts cancel out, and none of them intended to deliver the gold or to take delivery of the gold. And so it's just a sort of a gambling game, a casino, if you will, that goes on in the paper markets for the most part. But, to me, David, there has to be a change in the mindset of participants in the gold market. I think you have to see people that are heavily not even in gold so much now as they're in stocks and so forth, coming to see the need to have the physical metal, as you say. And clearly, I don't, if I talk to my colleagues and people I know in New York City, I still think if I were to walk down the streets of New York City right now, it wouldn't be 1 in 100 to think owning physical gold is that important. Yeah. And yet the Chinese see it, and they're buying gold and silver and socking it away. Clearly, they don't trust their government. They don't trust that the yuan is going to be worth anything in the future. Well, they sure do have Americans believing that the PhD standard is working just fine.
Yeah, but I think, Jay, that the way that you would see impact is palladium and silver, if they go into shortage and there's knowledge of delivery fails, because of that leverage that exists in the gold market as well, that you just need, people can just, they don't digest information sometimes. They say, yeah, I'm sitting in a paper position. But if somebody has written a contract and they are on the hook to deliver, and they see these other markets not able to secure the metal, then it's going to be a whole, you know what, I better make sure I secure the metal so that I can make the delivery. And then because of the leverage, you only need
small percentage,
1% of them or less to wake up to the leverage issue. And then you've got a market event of a delivery fail, and London is the market. It's the grandparent of all markets for precious metals, and I think we're heading in that direction now.
Yeah, I couldn't agree with you more. I think it could a panic out of paper into the metals is what unfortunately, I say unfortunately because it wouldn't have needed to come to this if we had never severed gold and silver from the currency from the United States dollar. But that's a whole other topic that we talk about often. I want to thank you. Anything else you'd like to add today, David?
Just a quick note there on Dmitry Spek's update of the manipulation. He's put out an article called "Can the New Silver Fix End the Ongoing Silver Price Manipulation?" And in it he gives a statistical analysis of what the traders call banging the close, but really the driving down of both silver and gold at the close on the LBMA over a decade-long plus period. And I really suggest people have a look at that because he can give statistical quantification. And what's interesting is that the silver price was actually manipulated more at the close than the gold price, but both were definitely manipulated using paper. So, and I think what we've seen now is we've seen basically the bullion banks come sprinting away from the silver fix, and they're looking very nervous about the gold fix as well. And the silver fix has been taken over by CME and Reuters, but we saw in 2013 the LBMA stopped giving lease data on silver, and then now the bullion banks have pushed away from the silver fixing, and so I think there's one more piece of data. There's something wrong with the silver market there in London, so we'll have to keep an eye on it.
Yeah, we certainly will, which, though, I just thought of another question I'd like to ask you before we say goodbye today, and that is, do you think the new players, they've got a new silver fix, is it going to be anything different? Or this? I mean, I'm not so sure about some of the guys, some of the participants you just named in the new silver fix. I can trust any more than the ones that have been in the old fix.
No, and they're basically still trading paper, no matter, first of all, it's an opaque system they have for setting the fix. And secondly, they're still trading paper. That's the root issue. It's the fix was, you could manipulate the fix because of the paper that was traded, but you can always sell down the metal, and you can always sell metal that you don't have with paper. And that has not been addressed. That's the root issue. The manipulation at the close was an application of that paper trading, but it's the root problem has not been remotely addressed.
Yeah. Well, that's exactly right, and maybe I'm sure that the powers that be, the status quo, don't want to address it and won't address it until they're forced to address it, and that would be a market event, I would imagine, that would possibly shed the light on the darkness that we have intentionally created by the ruling elite, I'm afraid. So. Anyway, well, thank you very much, David, once again for being with us and helping us see the light on the precious metals markets.
Thanks very much, Jay.